Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 4.3 of Unit 4, Forex Basics. In this lesson, we're going to cover leverage and margin in Forex trading. By the end of this video, you will understand how to use leverage safely and manage your risk. Let's get into it. So, what is leverage? Leverage is borrowed money from your broker that lets you control a larger position in the market. Think of it like a loan that you use to buy more of something than you could afford with your own money. For example, if you have a leverage of 100:1, that means $1,000 in your account can control $100,000 in the market. This means you can make more money if the market moves in your favor, but you can also lose more if it moves against you. Now let's talk about margin. Margin is the deposit required to open a leverage position. It's like a good faith deposit that you put down to show that you're serious about the trade. The margin acts as a guarantee that you will pay back the borrowed money. Here's the thing about leverage. It amplifies both profits and losses equally. This means that if the market moves in your favor, you can make a lot of money, but if it moves against you, you can lose a lot of money. This is the key danger of leverage, and it's something you need to be aware of. For example, if you have a leverage of 100:1 and the market moves 1% against you, you can lose your entire margin. This is because the leverage is so high that even a small move in the market can result in big losses. If your account equity falls too low, you may receive a margin call from your broker. This is a warning that you need to deposit more money into your account or close some of your positions to reduce your risk. If you ignore the margin call and your account equity falls to 50% of the required margin, your broker may close your trades automatically. This is called a forced closure, and it's something you want to avoid at all costs. So what's the beginner's rule for using leverage? It's simple. Use low leverage, 10:1 or less, until you fully understand risk management. This will help you avoid big losses and give you time to learn how to trade safely. Leverage is a tool, and like any tool, it can be used correctly or incorrectly. Used correctly, leverage can help you make more money and achieve your trading goals. Used incorrectly, it can destroy your account and leave you with big losses. To summarize, leverage is borrowed money that lets you control a larger position in the market. Margin is the deposit required to open a leverage position, and it acts as a guarantee that you will pay back the borrowed money. Leverage amplifies both profits and losses equally, and it's essential to use it safely and manage your risk. That is everything for lesson 4.3, Leverage and Margin Explained. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.